Welcome to FinAc Plus Finishing School. We bridge the gap between academic concepts and real-world application across accounting, banking, corporate finance, capital markets, risk, ESG, and more. In each video, we explain not just what financial terms mean, but how they work in real business environments. Today's topic: balance sheet assets or liabilities.
Hi everyone, I am Prabhakar, CEO of FinAc Plus. As part of our FinAc Plus Finishing School initiative, we are taking up few topics for practical understanding of the students from finance community, and this will help you to get into various kinds of opportunities available in the finance field. So our first topic here is accounting and balance sheet of a business and practical understanding. So today let us understand one of the most important financial statements in accounting, the balance sheet of a business, and more importantly, how to understand it practically. The balance sheet shows financial position of a company at a specific point in time. You can think of it as a financial snapshot that explains what the business owns, what it owes, and what ultimately belongs to owners. So the balance sheet is based on very important accounting equation, that is, you can see here. So it is balance sheet and assets, and we call liabilities, but so you have shareholders' capital, reserves, and liabilities. And then long-term liabilities, and then current liabilities. Here you have fixed assets, investments, and current assets. So let us assume the company has got 10 crores worth of assets, including all these fixed assets, investments, and current assets. Out of this, suppose company has taken bank loans of and supplier credit totaling 6 crores. That means these two are 6 crores. And this all together is 10 crores. Then you have 4 crores of equity, so including shareholder capital and reserves. This equation always balances, which is why it is called balance sheet. Now let us understand it, each component practically. So assets represents resources used to run and grow the business, such as cash available for operations, receivables expected from customers, and then inventory ready for sale, buildings, machinery, and technology platforms generating revenue. So all put together becomes assets. And liabilities represent funding obtained from external parties like banks, lenders, vendors, statutory obligations like tax payable, part of this current liabilities. And then the higher liabilities may indicate expansion funding, but excessive debt can also increase the financial risk. So if this is, let us say instead of 6 crores, it becomes 8 crores or 9 crores, that means you have only 1 crore, that means there is more financial risk on the company. So equity represents the true ownership value of the business. It shows how much belongs to shareholders after settling all obligations. Now, what does a balance sheet actually tell us? First, it indicates financial strength, whether a company has built the assets through sustainable growth or not. That means how much share capital percentage. So you have 4 crores. That means 40% of your assets are funded by share capital and reserves. Second, it helps us assess the liquidity, meaning whether short-term assets like cash and receivables are sufficient to meet short-term liabilities. So this is also called current ratio. Let us say your current assets are 3 crores, and then your current liabilities are 2 crores. So it is a healthy sign. If it is reverse, that means you have working capital deficiency. That means you have a technical insolvency situation when your current liabilities are more than current assets. So then, third, it explains the company capital structure, how much business depends on borrowings versus own funding. So it is debt equity ratio, you can say. So here you have, this is the equity and this is the debt long term. Generally in debt equity, we look at only long term liabilities. And then fourth, it gives insight into operational efficiency, especially through inventory levels, receivables collection, and payable management. So how much payables are there, and we will go further into current assets breakup in upcoming videos, but it tells us how much efficiency we have operationally. Now let us look at the terminology used globally. In most accounting practices, statement is called balance sheet. Under US GAAP, companies predominantly continue to use the term balance sheet in financial reporting. However, under the IFRS, International Financial Reporting Standards, official name used is the statement of financial position. Both are same, balance sheet or this is same. So when you read annual reports of global companies, both terms refer to the same financial statement describing the company's financial position. From a career perspective, professionals working in accounting, banking, lending, audit, equity research, and trade risks rely heavily on balance sheet. The balance sheet interpretation to understand stability, solvency, and the financial risk of the business. So whenever you look at the balance sheet, try to read beyond numbers. It actually tells the story of how a business is funded and how financially strong it is. In our upcoming sessions, we will discuss individual balance sheet components in very detail, including assets, liabilities, equity structure, and how analysts interpret each item in real business situations. Thank you very much.
Thank you for learning with FinAc Plus Finishing School. We hope this session gave you practical insights into real-world finance. Our goal is to help you build industry-ready knowledge for stronger career growth. If you found this helpful, please like, subscribe, and share. Let us know what topics you'd like us to cover next. See you in the next session.